Welcome to the Deep Dive.
Hello.
Today, we're really getting into the details of Phreesia's recent earnings call. This was for their first quarter of fiscal year 2026.
That's right. We've spent some time going through the call transcript, looking at the presentation slides, all that good stuff.
And our goal here is pretty straightforward. We want to pull out the key financial points, what management's thinking sounds like, and what they're signaling about the future.
Yeah, basically cut through the jargon and give you the essentials so you can quickly grasp what's driving Phreesia right now.
Exactly. So you walk away understanding their performance, their strategy, and where things might be headed. Let's jump right in with the Q1 results snapshot.
Okay.
And I think the headline here really is a strong start to their fiscal year. Wouldn't you agree?
Absolutely. The numbers, they looked pretty solid across the board. If you start with revenue, they reported $115.9 million.
Okay.
And that's up a healthy 15% compared to the same quarter last year.
Right, 15% top line. And did that flow through to the bottom line? How did profitability look?
It did. Adjusted EBITDA came in at $20.8 million. So that's up almost 17%, a 16.7% year over year.
And the margin?
That puts their adjusted EBITDA margin at a solid 18% for the quarter.
18%. Okay. What about cash? That's always a key area.
Yeah, and this was really encouraging too. They ended the quarter with almost $91 million in cash and equivalents, so $90.9 million. That's up from about $84 million last quarter.
Okay, building cash.
Right. And it's not just a one-off. This is actually their fourth consecutive quarter, fourth in a row, with positive operating cash flow and positive free cash flow.
4 quarters. That's definitely a trend, not just a blip.
Exactly. It signals real consistency.
Yeah.
And if you look at the numbers, operating cash flow was $14.9 million. That's like $15.6 million better than last year.
Wow.
And free cash flow was $7.5 million, which is up $13.7 million year over year. That kind of cash generation, it really speaks volumes about the health of the underlying business.
Yeah, you can't fake positive free cash flow consistently like that. It shows the operations are efficient.
It really does. And you see it reflected in their core client metrics, too. Average healthcare services clients, AHSC, they call it.
Right.
That grew to 4,411. So they added 70 clients just in the quarter, and it's up 346 from a year ago.
So bringing more clients onto the platform, and are they getting more revenue from each client?
They are. Total revenue per average healthcare services client was $26,283. That number was up 6% year over year and also up 4% just from the prior quarter.
Okay, so more clients and more revenue per client. That's the sweet spot, isn't it?
That's the combination you want to see. It shows they're expanding their reach and deepening their relationships, providing more value. So yeah, overall, Q1 looks like solid execution.
All right, good overview of the Q1 numbers. Now let's dig a little deeper. What did management say was driving these results? What are the engines behind this growth?
Well, they pointed to a few key things. First, continued network growth, just adding more clients, expanding their footprint. Second, expanding their offerings. So building out more products and services to sell to those clients.
Makes sense.
And third, really driving operating leverage, getting more efficient as they scale. That's how you get that revenue growing faster than expenses, leading to that improved 18% EBITDA margin we talked about.
Right, leveraging those earlier investments in tech, and people seems to be paying off now.
Exactly. And that leads into their comments about the balance sheet. With that growing cash pile, they emphasize they have flexibility.
Flexibility for what exactly?
For opportunistic capital deployment, as they put it. Basically, they've got the financial muscle to make strategic moves, maybe acquisitions, if the right thing comes along.
Okay. And speaking of the future, they updated their guidance for the full fiscal year, FY26. What's the outlook?
So on the revenue side, they actually reiterated the previous guidance. They're sticking with the range of $472 million to $482 million.
Okay.
And it's worth mentioning that range assumes no M&A happens for the rest of the year. So purely organic growth projection there.
Got it. But the profitability outlook changed, didn't it?
Yes, and this was a key positive highlight from the call. They raised their adjusted EBITDA outlook. The new range is $85 million to $90 million for the full year.
And the old range was?
$78 million to $88 million. So the midpoint of the range went up by a nice $4.5 million. That signals increased confidence in their profitability for the year.
That's a significant bump. What about the client numbers?
They reiterated the AHSC outlook too, targeting around 4,500 clients by the end of the fiscal year. And they also expect that total revenue per client metric to keep increasing in FY26 compared to FY25.
So continued growth in both clients and revenue per client expected.
That's the plan. And that consistent positive cash flow we discussed, well, that really underpins everything. It gives them that financial health and the agility to invest, whether to building new products or maybe buying something strategic down the road.
Makes sense. Okay, let's shift gears a bit and talk strategy. What were some of the key themes that came out, especially maybe in the Q&A portion of the call? Management stressed product-led growth quite a bit. What does that really mean for Phreesia?
Yeah, they did emphasize that. Basically means they're focusing hard on developing and scaling products that deliver tangible, measurable results, not just bells and whistles, but actual solutions.
Like what? Any examples?
They mentioned things like their appointment readiness tools, tools for engaging patients after a visit, and their enhanced bill pay products. The point they made was these aren't just ideas, they're actively being used and showing a real impact for their clients.
So the products themselves are driving the value, which pulls in more usage and growth.
Exactly. It's about solving real problems for providers and patients through the tech itself. AI also came up quite a bit, didn't it?
It did. How are they weaving AI into the picture?
They described it as being integrated pretty much across the whole organization. It's not just one team's job. They see AI as a core enabling technology.
Enabling what specifically?
Enabling new features, making existing products smarter, basically finding ways to use AI to deliver more value to clients. It's baked into their current and future product development.
Okay. Let's talk about their different business lines. Network solutions, that's the part serving life sciences, pharma companies. How's that performing?
Sounded quite resilient. They specifically mentioned nice growth there. They credited their team in the ongoing product development.
Even with maybe some budget pressures in that sector?
Yeah, they acknowledged that. They said they hear conversations about potential hesitancy from some life sciences clients in the current environment, but their argument is that Phreesia's platform delivers clear value and ROI.
So the results overcome the caution.
That's the idea. They can demonstrate the return on investment for the campaigns run on their platform, which helps justify the spend, even if budgets are tight elsewhere.
And what about the provider side, their core healthcare services market?
It's still competitive, no doubt. But management emphasized that focusing on value-driven products is key. They're still adding new provider clients and, importantly, generating more revenue from the clients they already have. It shows providers are willing to invest if the solution clearly helps them.
Okay. Going back to network solutions, quickly, there was some discussion about how those campaigns work, flexibility, ROI.
Right. So these campaigns, especially with pharma, often need to go through a strict review process, MLR they call it.
Right.
Medical, legal, regulatory. That's standard.
Okay.
Phreesia provides flexibility, though. Clients can adjust how big a campaign is, how often it runs, based on their needs and budgets. And management made an interesting point. They often get additional budget from these clients during the year.
Why is that?
Because they consistently show strong ROI. The campaigns work, they reach the right patients, and so clients decide to allocate more money to it because it's effective. Plus, Phreesia's growing network scale makes it more attractive.
Makes sense. Invest more in what works. Now let's look at expenses. Sales and marketing, G&A. They seem to show good leverage.
Yeah, management explained this as basically reaping the rewards of investments they made earlier. They built up the teams and infrastructure over the past few years.
And now they're seeing the efficiency gains.
Exactly. And looking ahead, they expect the spending trend in those specific areas, S&M and G&A, to be relatively flat for the rest of the fiscal year.
Which helps support that higher EBITDA guidance.
Precisely.
Yeah.
They don't anticipate big cost increases there.
Okay. With that growing cash balance, capital deployment is obviously a hot topic. How are they thinking about acquisitions or inorganic growth?
Their philosophy hasn't fundamentally changed, according to management. They look at a lot of potential deals. They use this buy, build, or rent framework, meaning they weigh whether it's better to acquire a company for a certain capability, build it themselves internally, or maybe just partner to access it. It's about time, cost, and strategic fit.
So having more cash doesn't necessarily mean they'll go on a buying spree.
Not automatically. They stressed the extra capital gives them more opportunity, sure. But the criteria for evaluating a deal remain the same. It has to make strategic and financial sense. They did briefly mention the Connect on Call acquisition had a bit of a setback initially.
Oh.
Yeah, sounded like maybe an integration hiccup. But they said the team got it resolved successfully. Shows they can handle those post-acquisition challenges.
Good to know. There was also a question about payment processing revenue. it saw a seasonal bump in Q1.
Yeah, that's pretty typical. The volume there is tied directly to people using their products, especially the patient bill pay feature they rolled out last year, which seems to be gaining traction.
And the seasonality.
Well, Phreesia's Q1 includes January. That's when deductibles reset for many people, so out-of-pocket healthcare spending tends to jump. More spending means more use of bill pay.
Ah, right, deductible season.
Exactly. So they expect that pattern, a bump in their fiscal Q1, then things kind of flatten out for the rest of the year. They anticipate the cadence will continue.
Okay, what about hiring? There was a clarification about headcount numbers from a previous filing.
Yes, management clarified that a significant headcount increase mentioned in their prior year 10K filing was mainly because they consolidated Phreesia India.
So bringing an existing team fully in-house, basically.
Right. It wasn't like a massive wave of brand new hiring across the board, more of an accounting and organizational change related to that specific team.
Got it. Any talk about risks, legislative risks, maybe? Something called the No Handouts for Drug Ads Act came up.
Yeah, that's some proposed legislation that could potentially limit tax deductions for direct-to-consumer drug ads. Management's take was, well, there's always legislative noise.
Okay.
But they feel their platform is different. They focus on delivering personalized health info based on privacy and patient consent, not broad-based advertising. So they believe their value proposition holds up, regardless of what happens with general DTC ad regulations.
They feel their position differently. Interesting. Let's look at the subscription segment again, the provider side. They highlighted better revenue per client there.
They did. Called it the best growth rate they've seen in that metric since 2021, if you exclude a one-off item back then.
What's driving that improvement?
A few things, apparently. One is the ramp up of newer product modules they've launched. Clients are adopting them. Two is expansion within existing clients selling more stuff to the customers they already have.
Upselling and cross-selling.
Exactly. And third, they're attracting new clients who are starting out at a higher revenue level and have shorter payback periods for Phreesia. They mentioned products highlighted in recent letters are contributing here.
Okay, circling back to AI again, but this time thinking about competition. How does Phreesia see AI impacting the landscape?
Management views AI as a powerful tool to build better solutions. But they stress that clients aren't just buying AI in a vacuum. They're buying solutions to complex healthcare problems.
So it's about the outcome, not just the tech buzzword.
Right. And they actually observed a trend where some clients are coming back to Phreesia. Maybe they tried a smaller VC-funded startup that promised the moon with AI.
That didn't deliver.
Or lacked stable funding or a clear strategy. Phreesia sees clients returning to establish trusted partners who can actually deliver reliable value. For them, AI is a way to enhance that value for clients and ultimately drive returns for investors.
Interesting dynamic. Now, a pretty significant announcement was the new share repurchase plan.
Yes, the board approved a plan allowing the company to buy back up to 2.5 million of its own shares.
What's the thinking behind that? Are they planning regular buybacks now?
Management framed it as purely opportunistic. They pointed to the stock's historical volatility. This plan gives them the option to step in and buy shares if the price sees a major dip, a significant market dislocation, as they put it.
So if they think the stock is significantly undervalued by the market.
Exactly. It's a tool to potentially return capital if they see a really attractive entry point on their own stock. But they were quite clear. This doesn't signal a shift to regular ongoing buybacks as part of their main capital allocation strategy. It's for specific opportunistic situations.
Okay, got that distinction. There was also a quick clarification on some non-recurring revenue in related services.
Yeah, just a small point. They had a bit of a revenue bump from providing some extra one-off services to a specific client. They called it out for transparency.
But it doesn't change the core business model.
No, management said it's just part of adding value for an existing client within their current structure, not a fundamental shift.
All right. And lastly, Medifind. They acquired this company, right? How are they thinking about monetizing it?
They described it as being in the first inning of monetization, so very early days.
But it is contributing revenue already.
Yes, it's adding some revenue post-acquisition, and they plan to keep investing in it. The core idea behind Medifind is helping patients find the right doctors or specialists and connecting them into Phreesia's network.
Like a provider search and connection tool?
Pretty much. They said feedback has been positive, and they believe it addresses a really big pain point in healthcare, that navigation piece. They see potential for it to become a much more significant contributor in the coming years.
Okay, a lot to unpack there. So let's try and pull these threads together for you, the listener. What's the big picture from Phreesia's Q1 call?
Well, first off, a strong start to their fiscal year. Solid numbers, good revenue growth, and importantly, they raised their profit outlook, the adjusted EBITDA guidance for the full year. That's a clear signal of confidence.
And that performance seems driven by their strategy playing out, focusing on product innovation that delivers value, good sales execution, and getting leverage from those earlier investments.
Right. They seem resilient in both their provider market and the life sciences network solutions segment. The balance sheet looks strong, cash is growing, giving them that strategic flexibility we talked about.
And looking forward, keep an eye on how they integrate AI further, and also this MetaFind platform, which they clearly see as a potentially significant, albeit early stage, growth driver.
Yeah, understanding these pieces helps you see beyond just the headline numbers. You get a feel for how their strategy translates into results, how they handle market pressures, and where they're placing their bets for future growth.
Okay, now just a quick but very important disclaimer here. Everything we've talked about today is based on our interpretation of Phreesia's Q1 FY26 earnings call and related materials.
That's right. We discuss forward-looking statements made by management, which naturally involve risks and uncertainties. Things might not pan out exactly as expected.
And we mentioned some non-GAAP financial measures like adjusted EBITDA. You should always look at those alongside the official GAAP results found in their filings.
Crucially, this deep dive is for informational purposes only. It is absolutely not investment advice. We're not recommending you buy or sell Phreesia stock or any other security.
Investing carries risk. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions.
Okay, with that necessary bit out of the way, let's recap the main takeaways. Solid Q1, higher EBITDA guidance for the year, continued focus on product-led growth, AI integration, the early potential of MetaFind, and that opportunistic share buyback authorization.
So as you digest all that, here's something to think about. Phreesia talks a lot about AI and connecting patients and providers, with MetaFind being just the first inning. Beyond the obvious stuff like booking or billing, what are some less obvious ways technology could totally reshape how you find, choose, and interact with healthcare providers in the next few years?
And how might a company like Phreesia, sitting on that network and data, be positioned to capture value as that experience potentially transforms?
Definitely something to ponder.
Food for thought.
Thank you for joining us for this deep dive into Phreesia's Q1 earnings. We'll likely be back with an update in about 90 days after their next call.